The following interview was recorded for PrivateEquity.com radio and the Certified Private Equity Professional CPEP Certificate Program. For more great interviews and other private equity resources, visit PrivateEquity.com.
Today we have Timothy Golon, a private equity consultant with 20 years of experience in the financial services industry, specific to alternative investments. He's worked in many areas related to private equity, including legal documents, structures, valuations, due diligence, IT and software-related issues, and investor relations. Timothy also serves on our Private Equity Advisory Board for the Certified Private Equity Professional Program. Thank you for joining us today, Timothy.
Thank you for having me. I appreciate it.
Yeah, I'm looking forward to our talk. It should be an interesting one. Just to start off and give a little more background, I gave a little introduction there, but if you could give the audience a little sense of what your professional experience was prior to entering private equity industry and services. Did you work in investment banking or related field, anything like that?
Well, first off, I started working on, while I was going to college at Hofstra University in Long Island, I first started working on partnership tax returns, real estate funds, for the company that I was working for during my college days. And that branched off into the investment banking world, where I spent a number of years with several different firms, among them Citibank, Lehman Brothers, as well as a firm, Oppenheimer. Mm-hmm. And then after that's where I gained most of my experience. But then after that, I branched out into the outsourcing world because I thought that I could better service many firms instead of just one firm. And it's worked out pretty well for me. And now I took that a little bit further, and I'm a consultant for, again, many different private equity firms.
Okay, great. And do you think that real estate experience, do you think that translated well into your later work with private equity firms? Are they very different industries, obviously, but is there any similarities you gleaned from that?
Yeah, what happened was once I graduated college, the firm didn't really have a lot for me to move forward in.
Sure.
So that's when I moved off into the investment banking world at Oppenheimer, and I was doing tax work there for a number of different funds that they had. And then they started to branch out those funds into more traditional private equity funds than what they were having. So that's where I started, and I got most of my experience. And then I moved on to Solomon Brothers, which eventually became Citigroup through various mergers.
Sure.
And I branched off into accounting at that point, not just tax services. And then it just broadened from there because they started tapping into me for IT perspectives, mm-hmm. new software products that were coming into the market to test them before they purchased them, and also the structures of the entities from a legal standpoint.
Okay.
And that just blossomed into a career supporting private equity firm.
Okay, and a little more specific to that, how have you worked with private equity firms, in what capacity? Like if you were to come in as a private equity consultant, how would that relationship progress? What capacity do you serve in that regard?
Well, basically the way it works with the firms that I'm consulting for now is I explain to them my background, like I mentioned to you, and then they basically pick and choose what services they like. A lot of times they may not want a legal perspective, since I'm not a licensed attorney, and they're paying their attorneys anyway, so they tap into them. But they do run things by me, basically, mm-hmm. just before they get to speak to attorneys because, they don't have a legal background.
Sure.
So I give them advice from the legal perspective on setting up a structure, the partnership agreements, the marketing materials, how to market them. Again, based on my experience and what I've seen across many other funds, I can give them sort of a perspective of how to launch their first fund. They may have a soft circle of investors, but they just want to make, all the ducks in a row, basically. And that's where I would come into play.
No, I think that's really interesting because a lot of the people that we've interact with through PrivateEquity.com and through our professional program are looking to launch their first time fund, and so I wondered if you had any sort of advice or how they would get started in that process. It would just be reaching out to a consultant like you or somebody who can sort of lead them along the way and make sure they don't miss any steps and have all their ducks in a row.
Yeah, the way it would work, there's a lot of funds out there that they can search through on the web, and also places like yourself, advisory committees. They can get information there and then tap into those people that they find, and they can give them advice, obviously for a fee, but It's going to be a lot less than you would pay the attorneys or an audit firm to do this similar kind of work. So the private equity consultants that I'm attached to and the private equity consulting firms that I'm attached to, it's just a lot more cost effective for them to use these as a starting point rather than go directly to an audit firm or a legal firm, because the fees are a lot more that are associated with those particular firms.
Great. I think that's a valuable insight for a lot of emerging managers and startups out there. Okay.
Yeah, because it cuts into their management fee.
Sure.
When they bill it back to the fund, they have to pay the preferred return, as stated in the partnership agreement, on these capital calls for all the expenses that they have. So it's really more beneficial for them to go to a low-cost solution as a start, and then because they don't have that particular background, they just have the investment banking background, they can then go to the attorneys and, lay it out for them in such a way that it's not going to cost them so much once they get the actual legal documents drafted from the attorneys.
Yeah, I think that makes sense. Okay. Well, one area we really wanted to tackle today is the Institutional Limited Partners Association. And so first I'm going to give a little bit of the background on that association, and then we can lead into some of the areas you wanted to tackle today, and that I'm excited to learn a little bit more about with ILPA. So if you'll allow me to give a quick background here. So some background to those unfamiliar with Institutional Limited Partners Association. ILPA began in the 1990s as a networking group for some powerful institutional investors, pension funds, endowments, so that they could share insights, ideas, and network. While the early focus was sharing information and networking, the investors gradually sought to add new members and tackled problems facing the institutional investors, things like fees and investment terms, pretty important to institutional money. So it was only a group of less than 20 investors in the early days, but today there are more than 250 members controlling close to $1 trillion in private equity assets under management. ILPA represents a significant chunk of money for buyout firms, and the association used that position to leverage in order to secure better terms for LPs and to advocate on certain issues like governance and reporting. The association has produced its ILPA Private Equity Principles, which serves as a guideline for GPs that hope to secure capital from ILPA members. And it's had a substantial effect on the GP and LP relationship. Today we're going to talk with Timothy on the ILPA rules update and how it has affected private equity. And Timothy, can you please provide a quick overview of the big changes you noticed in the updated rules and background on the important components of ILPA's principles?
Well, one of the major things that these institutional investors and the pension firms discuss with GPs regarding the ILPA guidelines is disclosure. Mm-hmm. And it's disclosure on the investments that are made, the capital call notices and the distribution notices, the nature of them that come out. In the past, a lot of the buyout funds, not really so much with the hedge funds, but with the buyout funds, there wasn't a lot of disclosure regarding the investments. They would just say, okay, we're calling capital for an investment in the media industry, a media company. And these institutional investors, as well as some of the other investors, they didn't really like that too much. They wanted to know what they're investing in. They wanted to know the nature of the distributions, more disclosure on the financial statements in addition to the footnotes. They just wanted more flavor and more color in what was going on with their particular investment. When you invest in a public company, there's a lot of disclosure through the SEC reporting that needs to get done. There's a lot of reporting about who works for the firm, different areas like that a lot of the private equity funds weren't sharing.
Sure.
When you go to some of their websites, it's basically just a login for an LP to know what their investment is in the particular firm. Mm-hmm. There's not a lot of disclosure about what the firm does, who works for the firm, what their backgrounds are. So that was one of the major things that ILPA changed mm-hmm. with their guidelines. And one of the major reasons was, a lot of these pension funds, they're giving a lot of money into the alternative investment world, whether it be buyout funds, venture capital, hedge funds, real estate funds. They're giving a pretty significant amount into these funds. You're not talking about a $500,000 or even $1 million investment, which a lot of the high net worth individuals and trust funds put in. You're talking about investments of $10 to $20 million that they're paying a 1.5% or 2% management fee on mm-hmm. to give to the GPs to manage their investment. And they just want to know what's going on. And that was one of the major things that has come into play with the ILPA guidelines. And a lot of other investors, aside from institutional investors and pension funds, are kind of jumping on this bandwagon of disclosure. Because, again, you're paying a management fee on this. What's it going to? What's my return going to be? They want more disclosure in the partnership agreements. Partnership agreements used to be like 10 pages. Now there could be upwards of 50 to 100 pages just in the agreement alone.
Yeah, I think to those new to the industry or those with just a short memory, that might seem surprising that the documents were that slim and that there was that lack of disclosure. Because it seems like today, a lot of the larger funds, at least, there's such an emphasis on that in recent years. But it is largely, I think, a reaction to ILPA. So that's pretty.
Yeah. A simple thing like remaining commitment. A lot of the funds weren't showing what the remaining commitment is. And, wow. The pension funds and the institutional investors, they'll keep track of their books and everything. But it would be nice to get a piece of paper from the investment firm, from the GP, on what they owe them on their commitment. They'll commit $10 million. All right, it's been 3 years. How much more money do I owe you? Does the management fee decrease over time? They just want disclosure. They want to know what's going on. Just like I mentioned with public securities, there's a lot of disclosure there in these SEC documents and on the websites of these public firms. Whereas in the private equity market, there's just not a lot of disclosure on the websites, and there's really no SEC reporting yet, although that's going to change as well, which we could get into.
Sure. Yeah, no, I think, I recall, I think it was a Texas pension fund manager was one of the real leaders on ILPA in pushing for these types of terms and these disclosures because, he'd been on the other side of the table. He came from private equity, and he knew exactly what those negotiations were like and exactly what he wanted out of those negotiations and what he wanted in the in writing at the end of the meeting. So I think that's largely a function of his influence as well as the other ILPA members. So that's great. And I guess
with the SEC reporting that's going to be required with a lot of these GP managers going forward, the investors, they want to know, where is the money going to come from? Am I going to get a capital call because you have extra reporting to do through your attorneys or your outsourcing firm based on the new SEC rules that are going to come into place? They just want disclosure. They want to know what's going on.
Yeah, no, I think that's definitely the case. And I guess toward that point, personally, do you think the current level of disclosure required by both the government and limited partners is too burdensome, sufficient, or not enough? It sounds like from what you're saying, you think it's fairly reasonable to, when you're committing that type of capital, to have some of these disclosures. But what do you think of the current level?
Well, when I was working with the investment banks, they do a lot of disclosure because a lot of them are public firms, and it's the smaller firms that don't have the disclosure.
Sure.
And what I've been finding is that when I worked in the outsourcing world, and now when I work in the consulting world, it's not too much of a burden. There is the initial cost of setting things up, like in a software program instead of using Excel. A lot of the ILPA rules require you to use a software product rather than just, basically using a spreadsheet. So there is that level right there. So there's an initial upfront cost, but it's not too burdensome on some of these funds. And a lot of the funds do bill back these costs to the investors. So, for example, an outsourcing firm that would have the resources and the infrastructure built to handle these additional disclosures and again, turning a 10-page document into a 50-page document, there is some initial upfront cost, but that's billed back to the funds, or the GPs will pay it out of the management fee, but it's a one-time cost. It's not, something that's significant on an ongoing basis. And then the LPs are pretty happy about it. They like the additional disclosure. They're very appreciative of it.
I think if private equity firms start to see it as resulting in better fundraising efforts, I think they won't be so.
Excellent point. That's exactly right. Because when you go to raise Fund 2, you're going out to do your soft circles and going out to, road shows and the like. They're going to ask you about disclosure, and you're going to tell them, okay, here's an example of what we provide, and it's attached into the marketing documents. And so the LPs are very happy about that when they see that you're providing all these disclosures and you're basically following the ILPA guidelines.
And do you think the disclosure and compliance costs are going to come down as these firms start to put in place that infrastructure in response to recent demands? You talked a lot about the upfront costs. So do you think we're going to see costs go down in subsequent funds as they already have the infrastructure in place, they already have the systems, the processes?
Well, I think that's where the consultants and where the outsourcing firms come in, because they have the infrastructure built already.
Sure.
It's the firms that don't use consultants or outsourcing firms where the costs are going to be pretty high, because, again, you're using an attorney who's going to bill you by the hour. They charge an enormous amount for these types of things, similar with the audit firms. So more and more you're seeing a lot of consulting firms tap into the private equity world because they know what's going on. They want this business. And instead of, I'll use a small example. The attorney will charge you $1,000 for a 1-hour phone call, where the private equity consultant will actually go into your office and speak with you for half a day, and they'll only charge you $500.
Sure.
Similar with the outsourcing firms. They have the infrastructure built already. They have software products that are up and running already. So for them to implement some of these firms, the costs are relatively low.
I think that makes sense. It's a little more hands-on with some of these consultants compared to what you get from your typical lawyer, or from if you're trying to handle this in-house. Okay. So I guess the next area I wanted to touch on, I think that was really interesting, on ILPA and everything they've been able to do in the private equity industry. But if you want to touch on performance reporting, and I was going to say, for those unfamiliar with how a private equity firm operates, if you could give just sort of an introduction on what the typical performance reporting process is, and then we can get into some of the recent changes.
Sure, we can discuss that.
Great.
My experience has been in this area. A lot of the private equity firms are not properly reporting this, or at least reporting it in such a way that's easy for an investor to understand. So ILPA kind of outlined a lot of that performance about IRRs and how capital calls are processed, and whether they're for investments, expenses, management fees, how management fees are charged in general, how it relates to over time. It's supposed to be reduced. There's a lot of guidelines that dictate this.
Sure.
And some of the private equity, again, the investment banks are kind of adhering to this because they're much more regulated. Again, they have SEC reporting to do, but it's some of the smaller firms that are feeling the burden on these reporting and on the performance numbers and how it works, because they're not used to that. So when they were in the investment banking world and they did a private equity fund, you had an infrastructure built in that public firm that would handle all of this reporting. But when you branch out and create a private equity fund, you don't have an infrastructure built, and you don't have the resources that will handle this. Some of these firms that I was dealing with the outsourcing, and also with the consulting I'm doing now, there's like 5 people in the firm. There's 1 office manager and 4 investment bankers. So they just don't have an infrastructure that's going to handle all of this kind of reporting and all this performance data that the investors want. They want performance not just on the fund, but they want it on individual investments.
Yeah.
For example, a fund could have 5 investments, a small private equity fund. 4 of the investments are doing average, but the 5th investment is doing phenomenal. So the private equity fund as a whole, the performance, the IRRs are through the roof.
Sure.
But it's not reflective of each individual investment. And you have to remember that the individual investors, they're paying for those other investments, not just the one home run that the company is reporting on. So when you see an IRR of, let's say, 50%, it's not indicative of each investment. That's the fund as a whole. So now they're asking to dig through that and look at it investment by investment.
Sure. No, I think that's an important point to raise. And I guess with this emphasis on performance reporting and really institutionalizing that, how have you seen reporting change in the post-Madoff world? Clearly, the Madoff scandal had a big effect on how LPs prioritized reporting and transparency, especially with hedge funds and similar vehicles. Madoff his investment vehicle was definitely different than private equity. But have you seen a big effect on private equity in that respect in the last couple of years?
Well, the one main focus that came out of the Madoff incident is, in addition to the audits, they want more transparency and more ownership of the books and records. Mm-hmm. And that's where a lot of the outsourcing firms come into play. More and more you're seeing outsourcing firms pop up all over the place. Sure. Whereas, let's say, there were 5, 10 years ago, there's now 100. Mm-hmm. I mean, those are not exact numbers, but it's more than tripled, quadrupled over the course of the last several years. Sure. And I go back to the infrastructure. These outsourcing firms have the infrastructure that's already in place where they can just take your information as a private equity fund and run through all the numbers, have their performance data there, have the software that's going to produce the reports that are required, that show the disclosure, that go into detail. Again, you talk about partnership agreements, used to be 10 pages, now they're 50. Reporting documents, a financial package that was sent out on a quarterly basis could be 10 pages, 10, 15 years ago, where now it's 30 pages of data that the investor goes to. And they like that. They like the firms to do that.
Yeah, it's a pretty important change, obviously. I think that's a great point. I guess to move on, I was wondering on the public side, Mitt Romney and Bain Capital dominated last year's news, obviously. But beyond that, we've seen private equity firms increasingly emerging in public over the last decade as firms like KKR, Blackstone, Carlyle make large buyouts of well-known brand names and big hires like David Petraeus recently. A lot of coverage has been negative over the years, but it has also been an opportunity for a group like the Private Equity Growth Capital Council and others to educate the public on what private equity is actually doing. Do you believe that all this attention on the industry has been constructive or negative overall?
What I'm finding from an LP perspective, they're not really too happy about their companies going public. Mm-hmm. There is a benefit there as far as disclosure, but then with a public company, you have all the increased fees that get passed upon the LPs. So their $10 million investment, and I'll just use a number just to throw it out there, $5 million goes to management fees and expenses, and only $5 million will go to investments. Because they have these high costs with the reporting that's required of public companies. Mm-hmm. And it's not just an annual report. Sometimes it's monthly. It's definitely quarterly. And there's a high cost in there in supporting that. Whether they do it in-house or they outsource it, it's an additional cost that gets passed upon the LPs. And a lot of them are not too pleased about that aspect of it because they want their $10 million investment as much as possible to go towards investments, sure, not expenses and management fees. But they do like the disclosure part of it. That they're happy about. But again, it's their money, they want to see it put to use as far as investments and not just expenses and management fees.
No, I think that's a important point regarding a lot. We haven't seen a ton of private equity firms going public, but there's been
no, there's not many
rumors of a few more joining. You always see rumors of an IPO, and then they back off when the market's not right. But I think that might be another consideration of it, that maybe these private equity firms are taking into consideration as they've seen a couple of their larger peers go out onto the market. So
and that goes back to the disclosure as well, because now when these companies like the KKRs of the world, they disclose that, okay, last year I paid $1 million in expenses and management fees. Now this year I'm paying $1.5 million. Why is there such a big increase? Oh, we're public, and now we pass on some of the costs of running a public company to our private equity funds. And again, they want their money to go to investments, not expenses and management fees.
Sure. Okay, and to move on to sort of the data and the IT aspect, which I know you have a background in working with private equity firms in that respect. How have private equity firms adapted to the needs by LPs to have closer to real-time performance data? What do you think of the IT solutions on the market today?
Well, years ago, there was very few IT firms that wanted to touch this particular area. Mm-hmm. Now you're seeing a lot more products. I've been to demonstrations through various road shows of several different private equity software products that are on the market today. And there is quite a few of them to choose from. Some are more user-friendly than others. Some are more difficult to use than others. And it all comes down to the cost involved to run these particular programs. The ILPA guidelines also dictate that, and I think I touched on this before, they don't want you using Excel for all of your accounting. Even the auditors, when they audit the particular funds, they just don't like 100% Excel. Yeah. Some things you're not going to get by without using Excel, because some of the private equity products that are out there just can't process some of the things as efficient as Excel would. Mm-hmm. But for general accounting, a general ledger package and producing the financial statements and trial balances and basically the books and records, you need to have a software product. And what it comes down to is the cost. And again, the cost is the burden of the cost is put on the investors. Sure. So when they see these increases in expenses, they want to know what they're paying for. So if a firm decides to go to a particular software package, they want to tap into that particular package as much as they can. They want web-based access so they can see their statements when they want to, not just on a quarterly basis or when a capital call or distribution notice is produced. They want to look at their web-based product, and they want to see just basically general information on where their account stands. Mm-hmm. Again, how much they owe the fund from their commitment, and just general information that a lot of these web-based products are producing these days. And it goes back to the transparency and the disclosures that the LPs want. They just don't want, once a quarter I get a financial statement. Yeah. Well, I just gave you $1 million, 2 months ago. What was that for? How is it being put to use?
Yeah,
So they like
$1 million
these web-based products, and a lot of the software firms are expanding on the web-based products. There's not too many that are out there these days, but a lot of the software firms that are developing the GL and accounting packages are attaching some form of web-based reporting so the LPs can get a look at what's going on, and not just, go into a library and look at PDF files of their K1 or their last capital call or the last set of financial statements. There's a lot more information that they can get on a real-time basis with some of the web-based products that are coming out with the software firms.
Oh, that's great. And I guess my final question is more on the GP side. How have you seen private equity firms improving their IT and data collecting when it comes to monitoring their portfolio companies' performance? It's not just their own, but being able to keep track of how their investments are doing for their own internal records. Have you seen any changes in that, or has it just been a gradual progression?
Well, that's another thing that was originally, it was all Excel-based, and now some of the software firms are getting into their data tracking points from an investment perspective. For example, your investments will throw off financial statements and financial information, financial data, metrics, all these different things. And the software products right now, so now they're basically producing 3 different products: a portfolio tracking module, a web-based reporting system so the LPs can see the data, and also the old-time general ledger, just the basic books and records. Mm-hmm. But a lot of the LPs, they want to see the metrics on the portfolio companies. Okay, I gave you $1 million for an investment. What's going on with the investment? You're telling me that the fund is doing great as a whole, but that's one of the 5 investments that you made is making the fund as a whole look phenomenal. Mm-hmm. So what are the metrics for each individual investment, and how are you reporting that? Because a lot of firms used to just issue basic financial statements. In the marketing materials that they sent out, they gave a little bit of history about different investments that they made in the past, but that doesn't help an investor that's currently investing right now in your new fund. They want to know what's going on with each particular investment. What are the metrics? What are the multiples? How is this particular firm doing? What are the expenses year to year? What's the debt ratios? They want to know all these different types of information. And now the software firms are producing this kind of record tracking information rather than just, somebody inputting it into an Excel spreadsheet.
Mm-hmm. Well, great. I think that was a terrific overview of, IT and data right now. I think the only person who didn't enjoy your answer is Steve Ballmer and Microsoft's team. I think there's definitely a shift away from Excel and towards these other software products and data solutions. But I think that's definitely to be expected with this type of sophisticated.
The auditors cringe over that, and the LPs, they're not happy that everything is in Excel. It's, it should be in some sort of a software package. And it goes back to, with Madoff doing his own books, I don't know what software product he was using, if it was just Excel, but it comes into play where the LPs, again, it's all about full disclosure, how the GP is operating. What are they doing? What systems are they using? Can I get access to data readily available instead of just waiting for you to issue financial statements or a capital call? And that's where the industry is progressing right now.
Well, great. So that's all the questions I had. Is there anything else you wanted to touch on that we didn't take on today?
Well, one thing I touched on before, I just want to elaborate a little bit, is
Sure.
the new SEC rules regarding private equity funds.
Mm-hmm.
It hasn't come into full effect yet, but it is going to come into effect where there are going to be different reporting requirements for non-public firms, SEC reporting. And
Is this Jobs Act related or Dodd-Frank?
excuse me?
Is this related to the Jobs Act, or is this the Dodd-Frank financial regulation, or just a specific SEC?
It's a combination of things that
Sure.
public companies and the investment banks, they report through the SEC. So in addition to getting the audits done, having attorneys review documents, you have a different level of ownership and that you have to support how your books and records are produced. So it's a different oversight that comes into play with the SEC rules. Certain firms will not have to file as often as others. There are different rules. It's not 100% yet, but some of the IT firms are building software products that will produce these particular forms and keep track of what's going on for the firms. But it all comes down to there's just an increased cost to the funds. So the GP won't pay this out of the management fee. They're going to bill this to the fund. So part of your $10 million investment, more of it's going to go to this new SEC reporting because it's a billable item to the particular fund.
Yeah,
whereas
a common theme.
Yeah, something like the salaries for the employees of the investment bank. That's not a billable expense to the fund. However, when you use an audit firm, an attorney, or some sort of third party, like an outsourcing firm, these are all costs that you can bill back to the fund.
Sure.
And then, again, it takes away from your $10 million investment to go towards expenses rather than actual investment companies.
Yeah, it definitely is. That's come up throughout the interview is passing that expense on to the fund. So definitely something that I'm sure private equity investors will be eager to pay attention to.
Right, and usually what I've found out recently is when the firms go to market with their funds, when they're doing their soft circles, when they're doing their private placement memorandums, they're disclosing this information that they anticipate, $500,000 a year of your commitment is going to go towards the audit and attorney fees and the outsourcing fees for them to do these kind of, books and records.
Okay. Well, I think that covers everything we were going to go through, and I just want to thank you so much for your time today. I'll give you
Thank you.
Quick reminder to the audience on who you are. And today our guest was Timothy Golon, a private equity consultant with 20 years of experience in the financial services industry, specific to alternative investments. He's worked in many areas related to private equity, as you just heard, including legal documents, structures, valuations, due diligence, IT and software-related issues, and investor relations. Timothy also serves on our private equity advisory board for the Certified Private Equity Professional, and he's just a valuable counsel out there and a very well-informed person on what's going on in the industry. So just thank you so much for your time today, Timothy. I really enjoyed our talk.
Well, thank you very much for having me.
Thank you for listening to PrivateEquity.com radio. If you would like more interviews, visit PrivateEquity.com. At PrivateEquity.com, we offer private equity data, webinars, training programs, networking events, and other valuable resources for private equity professionals.